Hi guys, good afternoon. My name is Andres Morales. I'm a local real estate broker with Bonaventure Realtors here in California. I'm also licensed in the state of Florida and the state of Washington. So I received an email from a local loan officer, and they sent me some really good information about some Fannie Mae changes that are happening July 29th, 2017. Some of the changes that are going to be Fannie Mae is going to enhance or change within their underwriting guidelines are going to be changes to the debt to income ratio, some changes to disputed accounts, some changes to self-employment documentation, some changes to the way the student loan cash out refinance is handled, as well as some changes to the ARM loan to value increases that they're going to be having, as well as treatment on some timeshares or on how they treat and view timeshares on your credit report. So let's go ahead and get started. Okay, so starting July 29th, the debt to income ratio currently, which is 45, is the maximum that the ratio a borrower can have in order to qualify for a loan, will be increased to a new maximum of 50%. So the debt to income ratio is exactly that. It's the lender uses the debt divided by the income in order to come out with a percentage. That percentage is what they use in order to qualify you for a loan. Currently, the max is 45%. If you do have your debt to income ratio is higher than that, let's say 45 to 50%, most likely you would go for an exception depending on underlying circumstances. And then from there, the lender could approve you. However, with the new enhancement, you can go all the way up to 50% of your income in order to qualify for the new purchase of your home, which is great because it's going to increase considerably the amount of buyers that are available for this market. And I think it's going to create a lot more demand for the current supply. The number two is for disputed accounts. So in the old days, borrowers will bombard the credit bureaus disputing any derogatory credit items. The bureaus had to remove the items while it was being investigated, which provided a small window for some borrowers to slip in and get a loan. Fannie Mae and Freddie Mac got wise to this loophole and said, okay, if you have a dispute, then we're not going to underwrite the loan until the dispute is resolved. Fannie Mae now, with the new changes that are going to happen, they will evaluate loan files with credit disputes, and in some cases will not require there any further action. So I hope you kind of understood that message. So before, people were, in order to dispute things or to remove things from their credit, would dispute it with the credit agencies, and they would remove those items. The credit agencies would remove these disputed items from the credit report. Fannie Mae and Freddie Mac found this out. So anytime they pulled up a credit and it said that an item was in dispute, generally Fannie Mae or Freddie Mac will not look at the file, will not even underwrite the file, will not fund any loans on the file. What this allows you to do is if you do have any disputes, they will go on a case-by-case basis in order to be able to underwrite your file and in order to get you a loan for the purchase. Kind of like a make sense decision basis type of deal with transaction, which is really going to help a lot of buyers who are currently in any position that they may be having some kind of disputes on their credit report. Number four, effective July 2017, which is, this one's really good. Most tax liens and civil judgments will not appear on credit reports, which is great because if they're not filed under a property or they're not filed with the county, your lenders won't be able to find this information, which allows you to get pre-approved for a loan. The downside to this is that if you do get, let's say, approved for a loan and the loan does get funded and the lender wasn't able to find about your specific tax lien or any specific lien that you have out there pending, what would happen is if that creditor found out that you purchased the home, they can attach that lien into your new property, and good luck trying to sell it without paying that specific lien or negotiating a lower balance payoff with the creditor. So it's a good thing, but it also has a downside. Number five, which I think is one of the best enhancements that the underwriter guidelines are going to have, which is the self-employed documentation. So currently, Fannie Mae requires 2 years federal tax returns for self-employed borrowers or W-2 buyers for that matter. The new enhancement is going to allow some, not all, some self-employed borrowers to submit just 1 year tax returns. Some LOs or loan officers say that this enhancement alone can be the best of the bunch, and it will really help many self-employed borrowers actually get into a home, which is great. I'm a self-employed individual, so for me, it's It's awesome. The key is getting the borrower pre-approved to determine if he or she is eligible for the 1-year requirement. Freddie Mac used to have the specific program. However, Freddie Mac recently modified their guidelines, which are no longer favorable for this type of buyer. The following enhancement that they're having is the student loan cash out refinance. So currently, if a borrower was trying to take cash out or refinance their property, they would get hit as if they were taking cash out. With this new enhancement is if a borrower is taking cash out to pay off a student loan, the refinance is not priced as a cash out loan. How does that help the current owner? That's going to help you by saving money in the long term, because there is a rate hit or there's a cost hit to the rate in order to get cash out for the property. So it's going to be a savings in the long term. It's going to save millions of dollars throughout the nation, which is a really good enhancement from what I'm seeing. The next enhancement is going to be to the adjustable rate mortgages. Adjustable rate mortgages and their loan to value. So currently, Fannie Mae is going to allow a max loan to value of 95% on adjustable rate mortgages. So the loan to value is the loan that you're getting divided by the value of the property, and you can get a loan up to 95%, which before was a lot lower than that. Number 8 is the treatment of timeshare loans. So currently, timeshare loans are treated as a mortgage type loan. When a lender sees a mortgage laid on your credit report for the first instinct, it stops the loan. Fannie Mae enhances the states that timeshares loan will be treated as an installment loan, like a car loan, which is great because it's not going to affect your credit. And prior to this specific enhancement, if you had a timeshare and you were late, it would be considered a mortgage late, which in many cases would disqualify you from a purchase loan or a refinance loan for that matter. So this is good that they're going to be started treating like a car loan because even after, if you just have let's say 9 months, or if you have a balance, or if you're going to pay it off, or if you're going to sell it, you should be able to not count it into your debt to income ratio. For that, you would have to contact your loan officer. All right, so I added the link where you can get these specific enhancements online from the Fannie Mae website. Again, trust and verify the information that I just shared with you. I do want to give a shout out to the person who provided this information for me, which is Mark Boslier. I hope I pronounced his name right, with Mortgage Advisor. So if you do have any loan questions or want to get pre-approved for a purchase, go ahead and reach Mark out at the information below. If you have any questions for me, please feel free to call me, text me, email me. And if I don't have the answer for your questions, I'll make sure that I get the answer for your questions. I hope you like this information and you found this information helpful. If you have, please leave a comment, share, or forward to anybody else that can find this information helpful. Again, thank you and have a blessed day.